Today is May 3rd, 2019. This is a new concept from the Resilient Advisor podcast that we are calling Forecast Free Friday. The goal is to help you build a more informed portfolio through the lens of history, math, and behavioral economics. My name is Jay Coulter, and my partner in this project is Clint Sorenson, who is the CIO of Wealth Shield, an outsourced CIO firm that supports over 115 advisors in the independent channel. Our plan is to keep these broadcasts very short. No fluff, no ads. Let's get to it. Clint, this week I attended the FA Magazine Inside Retirement Conference here in Atlanta. They did a really good job with the conference. And in speaking with advisors, something that kept coming up was this challenge they have allocating to international investments. And let me set the stage for you here. So if you look at the Schwab Broad International ETF, SCHF, which I own, and you look at the Schwab Broad Market ETF for the U.S., SCHB, which for full disclosure I own, look at the massive divergence in return since 2010, with international delivering 19% versus domestic 157%. Clint, is this why advisors and investors are ignoring the space?
Yeah, I mean, I think it's one of the reasons, right? And I'm glad you went to that conference. I wish I could have made it. I'm actually here in Austin now at the InvestNet conference. So you and I obviously talking from different locations occasionally. But yeah, going back to the international investments, advisors, you got to remember their clients have this natural home bias, right? And even the advisors have this home bias, and sometimes it's pronounced. It really starts with that aversion to ambiguity. Don't invest in something you don't understand or don't know. And so what you have is you have an under allocation to any equities that are not domestic, right? And so I think that's been one of the main reasons, or at least the foundation for why investors are underweight international, but also this performance disparity, right? It's obvious. There's been, since the global financial crisis, and really since 2011, you could call it, when international topped out from a technical perspective, you've had this massive inflow into the U.S. And so that's caused a continued or a widening disparity between international and domestic assets.
So let's look at the fundamentals here, and let's just use PE, trailing 12 months, so there's no fluff. So on the SCHB, they're showing a trailing PE of around 19 and a little closer to 15 on the international. So at a fundamental level, can you say that the international space is undervalued relative to the U.S., and how do you look at that?
Yeah, absolutely. So from a fundamental perspective, if you look at trailing 12 PEs, price to books, price to cash flows, you're looking at CAPEs, right? Cyclically adjusted price to earnings ratios. All of those tell a similar story. And that similar story is that developed, like international developed and international emerging, are undervalued relative to the U.S. Now, if you look at trailing PEs, like you just mentioned, if you just look at the U.S., it's 19.6 times trailing earnings, right? And if you account for the fact that we're most likely going to have flat to negative earnings year over year through the end of this year, well, then the E is staying put while we've run up 17%. So now you've got this multiple expansion, which just makes that a more pronounced divergence. Now, if you look at international assets, emerging markets are at 13.9, developed internationals at 17.2 on a trailing PE. So definitely a discount there relative to the U.S. And in terms of the way we look at that, valuations, what you're accounting for there is a mean reversion. And mean reversions take a long time. Mean reversions are not a one-year phenomenon, not even a 5-year phenomenon. So mean reversions, the valuations going to the average valuation, that sometimes takes 7 to 15 years. And so investors that are investing with valuations as their sole rule, right, they have to be very patient. And we know that behaviorally that can be very painful, right? Because you're moving against the herd a lot of times. So being a contrarian is not all it's cut out to be.
All right, so let's look at this through the technical lens, which I know is your favorite way to look at the markets. Contrast international and domestic for us.
Yeah, so from a relative momentum standpoint, which is a lot of the way we do asset class comparisons. So think of that like we arm wrestle the two. And then the winner, the strongest one on a total return, total return relative to volatility, we're going to select in an asset allocation process. So that's the technical strength we're looking for. So just typical relative strength. Actually, emerging markets has really stepped up and is one of our largest overweights. If you look at our asset allocation modeling that we do from a quarterly basis, on a quarterly basis, we arm wrestle everything international versus emerging, international developed versus emerging markets, U.S. large versus U.S. small, things like that. We arm wrestle them all, and then we do our over and underweighting mechanism based on who's the technically the strongest, right? And what we found is that actually international emerging stepping up. And so it has, largely based on the move we've seen in China, really stepped up to be one of the strongest asset classes we're tracking. And so that's carried international to finally being one of the strongest. We saw a little bit of that in 17, but really for the bulk of 18, it was weak. And up until 17, relatively weak as well.
Well, the reason you're such a great partner for Forecast Free Friday is you don't forecast. Everything is rules-based. And given the lens of those rules, what is the most overvalued sector right now?
Yeah, so if you look at it by country, it's actually Ireland is the most overvalued country from a CAPE perspective, then Denmark, but then the U.S. So the U.S. from an overvaluation, and I believe valuations are a technical indicator. I actually borrowed that from Matt Faber, but he said, look, what's in the numerator, and it's price, right? And so technical analysis is the study of price. And when you look at valuations from that lens, that technical indicator suggests that the U.S. is not only one of the most overvalued countries, but it's also one of the most overvalued instances in history. And so when you look at that, that doesn't mean it goes down tomorrow. It just means, look, we probably need to taper our expectations for returns going forward. But technically, it's still a very strong market. So the way we look at that is we say, hey, returns are probably going to be lower, but the trend's still up, and the trend is your friend until it ends. So make sure you're managing risk well, have a disciplined process.
Excellent. Hey, Clint, I'm really enjoying this podcast series here. I hope you enjoyed the rest of the InvestNet conference, and we'll talk next week.
Awesome. Thank you, Jay.